Hello everyone, welcome to Momentum Lab. I have Chaitanya with me. Chaitanya is a first generation entrepreneur who started his investment advisory firm, and he has a decade of experience before even running this firm with as an equity analyst and research analyst with companies like Crisil. And Chaitanya is BTech graduate in chemical engineering from IIT Madras and then did MBA in finance from ISB Hyderabad. It's a pleasure having you, Chaitanya. And Chaitanya, by the way, runs a PMS based out of Bangalore called as Courser Park. Chaitanya was also doing research investment advisory before starting his PMS. Once again, Chaitanya Garu, welcome on board, and it's a pleasure having you. Walk us through the journey that you have faced initially in the equity research side of it, and how was the transition from being an equity analyst to investment advisor?
Hey, thanks, Shekhar, for having me on your podcast, and thanks for the kind introduction that you just had. So I think in terms of the investing journey, I would sort of define it into three different phases of learning. The first phase, of course, started in March 2008. That was my first job on the buy side at a firm called Argonaut Private Equity. The beauty of the platform was that we could do both public markets as well as private markets. So it was a very unique experience. And I was just coming out of sell side, right? I was a banker right before that at a firm called Lazard. Now, enter March 2008. So we start doing this diligence on a number of companies. And naturally, the orientation initially was towards quantitative cheapness / value. Right. So in that realm, we had like companies like PSU banks, right? And then you had companies like City Union Bank. And then you had companies like, and such. Basically, City Union, I think we had, CCL, Consolidated Construction Limited, so on and so forth. The fundamental understanding there was, if a company is relatively cheap compared to rest of the market, as you now define it as value, we thought it would work wonders, right? Like City Union Bank was a case where it had a 150-year-old history, extremely professional management. Mr. Kamakodi, who was the CEO of the firm and is still the CEO of the firm, was a prolific banker, right? Then this Consolidated Construction Limited was a company which was started by L&T, ex-L&T professionals, and had a huge order book, right? And they were executing contracts as well as Ahluwalia Constructions and companies as such, right? And the third piece is the PSU piece. Very honestly speaking, the power of quality, we did not understand back then. Okay, so this is the context. So you look for companies which are cheap. You look for companies where there is a reasonable sort of protection towards the downside. And you know what happened. Like in September, I think September-ish, Lehman went bankrupt. So the share prices kept dropping, right? And we kept adding because it seemed like if we bought something at a higher price and then it drops, it becomes value. I mean, that was a traditional definition of value. We kept averaging down, Shekhar. We kept averaging down into October after the Lehman bust and all of that also.
Okay.
But to be honest with you, the drawdowns then, I don't think we have experienced anything like that till date.
Okay.
Right? The drawdowns were crazy.
Even the
and you
COVID
wouldn't.
crash?
Sorry? No,
Even
COVID crash was very it happened in a jiffy, right? It started in probably March, ended by April. Everybody doled out gobs of liquidity, right? So COVID crash was nothing. There, you would go back, you do all your analysis all over again, see, what are you missing? Like the implied NPAs in South Indian Bank, at that time we had that bank called South Indian Bank, was close to some 20-25% here. Basically, market was saying banks are bust. Right? So that was the context. So yeah, I mean, that's I think I was forged in that sort of situation. First job, buy side, trial by fire, GFC. So I think that was like, I think the key things that I got from there is, one, drawdowns are real, brace for them, right? Safety first. Now, safety first, how did I define safety first? I somehow had the feeling that because the balance sheet structures of some of the companies that we bought were not pristine, so they dropped much more than the market. So that was the first learning episode in my investing journey. The second thing was very, I would say, it was very lucky. So December of 2008 or something like that, I went to Delhi to visit one of my dear friends. And in his room, there was this book. It was a room. I mean, he was living out of a room. He was an entrepreneur and all of that, called The Little Book That Beats the Market by Greenblatt.
Okay.
It was a teeny weeny book, right?
Right.
You know it. You must have gone through it. And I just overnight, I went through that book. And that, I would say, was the defining moment of my investing career, right? Quality for the first time, defined as ROCE, and earnings yield. Earnings yield, of course, I was already sort of in the previous era while I was doing this, investing during GFC. Earnings yield was very familiar. It is not new. But quality as a factor, the first time I learned was in his room right there, reading through the book. So Greenblatt was, I think, the most influential factor in my investing journey. So then what did we do? I came back and we invested in a company called Amar Raja Batteries. From that trip, we came back because it was qualifying for quality, it was growing, it was reasonable valuation, and all of that, right? And it worked wonders. We even did diligence. So the only thing I would say, Shekhar, is that apart from using this, quality is a screener for us, then we go deep dive into the companies. Like we visited, repair shops, service guys, to figure out that the warranty period for Amar Raja was higher than Exide, to figure out that the service quality of Amar Raja was better than Exide. And they even had like a JV with Johnson Controls. Therefore, their lead acid batteries had higher cycle lives than Exide. So we invested in Amar Raja. I think it was I think from an outcome perspective, it was great. And that was the second point. Like I did Amar Raja, then we did this PI Industries,
Right.
Bayer Crop Science, then we did Persistent Systems for the first time, and companies like that. So I would say that period from 2008 to 2013 was primarily driven by quality. So 2008 till December was driven by value, quantitative cheapness. 2008 until 2013, May 2013, is when I quit Argonaut. So that is the time, I read bit of these technical books.
Like Cancel?
Where Canslim was slightly later. I mean, a little bit later.
Okay.
But like, RSI and, stuff like that, right?
Okay.
So then I realized that there is reason to believe that you can combine this quality with, these quantitative factors, right? And then what I did was, so I came to the conclusion that oversold quality, if we repeat the process over and over again, right, should deliver great numbers. So I then had the confidence, I sort of left my job at Argonaut and started this journey towards starting an RIA, which is RW Investment Advisors. So the first few months, I had these like a couple of programmers from JNTU. Together, we built this platform called Pivot. And it was a very simple platform. It was basically combining quality as a factor, right? Without so much knowledge of the businesses underlying them. It was pure quant platform. And then you buy them when they were oversold, right? And we back tested this probably for like 15 years or 16 years, and results were fabulous. So yeah, I mean, so that was quality out of favor, right? Around the same time frame, around this 2013 time frame, Shekhar, there were two more things happening. I was reading a number of books on one, quality, like Buffett, like Phil Fisher, that Common Stocks, Uncommon Profits. Then I was reading Bill Ackman. Bill Ackman had this huge Herbalife short during that time, and it was very public debate and all of that. So I was reading Bill Ackman, their newsletters and such. So that was so the quality was getting even more embedded into my psyche during that time. The second bit was the introduction for the first time to Jagdish Titman, right? Then William O'Neill. Then the third was, of course, Mark Minervini. And Minervini mentions a book called Super Performance Stocks by Tetlock or Lovelock, some such author, where in 1960s and 1965s, he gives you a graphic on how would you do if you had invested in high growth stocks.
Okay.
Right? It was simmering somewhere in my mind. I still fully did not absorb or understand the power of earnings growth at that point in time. Right? And this continued like 2014 till 2016, this path continued of just doing, quality at reasonable valuations. It was like you put a net for catching the fish, and it comes whenever it comes. And by fish, I mean earnings acceleration here, right? But then this again changed in 2016, right? 2016, what happened was Titan, the jeweler, of course, is the market leader and all of that. We were coming out of demonetization. I think September 2016 and December 2016 or something like that. The results of Titan were phenomenal. For the first time, I sort of stepped out of my comfort zone. Market leadership, quality, the underlying factors, Tata Group, and all of that was ensured. For the first time, I sort of went ahead. Valuations were sort of reasonable, Shekhar. They were not like completely out of whack or anything like that. So valuations were reasonable. It was a long consolidation because 2013, you had all those factors, right? I mean, stoppage of gold imports, putting more duties on imports and all of that. So all that went away and hallmarking came in. So long consolidation, great earnings, and okay valuations. Not very reasonable, but okay valuations. I invested in that stock, Titan. And it worked out very well. Like I think it was whatever, 65% to 70% in a couple of quarters or something like that. So that opened my mind to, sort of momentum. I would not say growth because the academic definition of growth is IP, right? I don't mean that. So I mean momentum. So these are the three different bases. Argonaut, first 1 year, quantitative cheapness. Next, went to quality 2009 to 2013. That continued for another couple of years. Enter 2016, I was exposed to growth. So this has been the journey.
Great, sir. I think the events that shape us actually have a bearing on the investing style that we choose. So at what point of time that you start your journey determines the style that you want, and especially that I can resonate. Like most of the people who have started to invest, especially post 2020, they're more inclined naturally towards momentum.
That's right.
But folks who have invested during the 2008 crash, they have a
Right.
different bent of mind, like you just mentioned. I think you were in that space
right.
that started, especially post 2008 GFC crash. It was your
That's right.
learning point. I think that was where the deep value, then growth made logical sense. And in fact, you were one of the earlier investors to find out PI Industries before Nalanda had also put down their money. Am I right, sir?
PI, I think Nalanda was not there in PI. I think Sequoia was there in PI, if I remember. I think Supreme Industries and such, I think Berger Paints was one more. We were there ahead of some of these entities, companies.
Got it. So you were doing these, what do you call as industry checks?
Oh, yeah. So see, basically for coming to a conclusion on something like PI Industries, right? You have these initial qualitative screeners. Then we went and sort of, and the purpose of these meetings was to understand the industry structure. We went and met Mr. Rajneesh Sarna, I think Mr. Anurag from PI Industries. Then we went and met, there was a council called Crop Care Council, which is effectively the leaders of all the agrochem companies in India. They get into council, and we went and met some of those people. We went and met competition like Insecticides India, Coromandel, trying to decipher the differences between fertilizers and agrochem, which is sort of better. So there was a lot of groundwork in order to understand, and there, we attended some agri melas and stuff, right? Where you will understand what is happening at the ground level. So
Right.
that was the intent. So you do that, and then you do this, and then if the valuations and all of this makes sense on your spreadsheets, that is when we would go and pull the trigger.
Got it. So in the quality definition that you've talked about, can you give us some light on some of the qualitative parameters like you've just talked about, like visiting the dealers, etc., and also the quantitative way of how do you define quality? Momentum and low volatility are pretty, and even alpha, they are pretty simple to calculate.
Right.
But quality and value, these two are different factors, and there's an alpha just for identifying or defining the way quality and value is done. So how do you define these two terms, quality and
great question, Shekhar. Yeah, great question. So see, quality for us is one is like the quantitative quality. Then we will go into the qualitative quality. Quantitative quality is ROE upwards of 15%. ROE is, of course, return on equity. Return on capital employed greater than 15%. In other words, levered and unlevered both need to be, returns on equity needs to be higher than 15%. So you put $100 in a company as a promoter. We need to see that business generate at least 15% post-tax return on an annual basis. That's first. Second, but ROE and ROC are primarily profit and loss related. They are P&L related, right? But you remember what happened in GFC. The balance sheets is what created the problem. So we want to ensure that the working capital cycle of a business is sub 90 days, less than 90 days.
Okay.
Right. The third piece is, yeah, it is good that you have working capital days less than 90 degrees. This could be operating working capital. But we also want to make sure that it is actually showing up in your cash flow statement. So my EBITDA to cash flow conversion, EBITDA divided by CFO, needs to be greater than 70% on an average over the last 5 years to 10 years.
Got it. So
right?
if I have
More
to
important.
Yeah,
Importantly, yeah, please go ahead.
So just to summarize, sir, ROE, ROC greater than 15%, EV by EBITDA greater than 70%, EBITDA by cash flow operations.
EBITDA by cash flow from operations greater than 70%. And net working capital days, sub 90 days.
Less than 90 days. Okay.
Less than 90 days, right? And of course, leverage needs to be as close to zero as possible. Like if you look at the portfolio characteristics of the stocks that we have right now at CPA, Courser Park, right? It will be closer to 0.1 or 0.2 net debt to equity.
Okay. So in that case, how about the financials, sir? Financial industry.
Financials, I need to carve out. You're absolutely right. So I'm telling you the numbers X of financials, because financials by definition will have leverage at least 7-8x. Yeah.
Right. Yeah.
So that I'm carving out. Rest of it is what I'm saying, 0.1 to 0.2, 0.3. Yeah, max. So if this is the quantitative sort of filters to start our journey, right? We would like to understand what is the story behind these numbers, right? I mean, this is fine, right? So we want to be in situations where the market share of the company is increasing.
Okay.
Right. Generally, market share depleting means, at some stage that will translate into lower earnings growth. Somebody else is growing in that industry faster than this guy. So it's better to be with the guy who has the highest earnings growth in a specific industry, right? That's one. Second, lot of ground level checks. See, in most of these spaces, we are not the experts. We only understand superficially all of these companies, right? So in general, talk to industry veterans, right? To try and understand, like, Timken, for instance. Timken is a bearings company. Try and speak with an auto expert in order to figure out what is the difference between roller, cylindrical, ball bearings, which is complex to manufacture, right? How many in India can actually manufacture, that sort of stuff. Is there a replacement demand to it? So these are all the qualitative checks that sort of come out, right? So you need to understand a business from multiple lenses. And obviously in India, it's lesser of a problem, no? But at some stage, the governance issues, if you remember 2010 to 2013 timeframe, governance was a big factor. You had hardly a handful of companies where they meet governance standards also, or unrelated diversifications, and all of that was limited. So we need to ensure for safety that governance is also given, right? So I mean, this is what I would say is qualitative stuff that you need to do, and it's very helpful for even a quant investor to understand what is within your portfolio.
Absolutely. And most of the quant investors have a myopic view of just looking at these stocks purely from the price and volume perspective, but ignoring that there's a business behind the portfolio that they own.
Absolutely. Yeah.
Sir, and while we try to build portfolios or strategies which are robust and time tested, but we'll see underperformance at some points of time. So how do you manage underperformance? Have you seen underperformance over your last 10-12 years of journey in the PMS? And if you have seen, how do you handle those, both from what kind of actions that you do on your portfolio to avoid underperformance, and also emotionally, psychologically?
Sure, Shekhar. Slightly taking a step back, right? I also wanted to we will address this question shortly, but I also wanted to address this momentum thing, right? Because both of us have done a lot of research on momentum. So there is a definition of just price momentum, things going 52-week highs and you chasing them, right? That's one. And then you have this Novomark's definition of momentum, which is driven by fundamentals. I mean, why is this important for us as quant investors is that I mean, you remember that study, I guess you have also studied that, right? 2005 paper where he says that real momentum is always driven by underlying earnings.
And yeah, earnings momentum.
Earnings momentum. So I think as a quant investor, we should all be oriented towards this earnings growth concept, the Minervini, the William O'Neill earnings acceleration concept, so on and so forth, right? Rather than chasing pure price momentum. That's one more thing I think, because you run Momentum Labs and you have like a huge audience, this is one more thing I think we should widely discuss and debate. Otherwise, if you look at any of the academic studies, right, they define this growth as high P. How can you define growth as high PER? Growth is earnings growth.
Right.
So academia somewhere, it's like they have drifted in a very different direction, right? Yeah, so I mean, so that's one more point I wanted to add, because in our portfolio, in general, we sweep out all the companies. We wait for 2 quarters. See, there are companies which are outstanding, which we want to hold for a long time, right? Everybody wants to do that. Nobody wants churn. But there are always these occasions where things go through slowdowns. And we generally give 2 quarters of earnings moderation. If it's a beautiful company, just hold on to it. It's okay. It's only a two quarter situation, right? But if the earnings slowdown is much more meaningful than that, or the market share loss is much more meaningful than what we are seeing temporarily, like Voltas went through this cycle of somewhat market share slowdown, therefore earnings slowdown, and suddenly it came out, right? So that's one more thing I wanted to put on the table. That is earnings momentum in general. I mean, momentum in general should be defined as price momentum driven by earnings momentum, not just price momentum, right? So these both we combine in that safety first paradigm. First, quality. Second, cross-sectional, instead of cross-sectional value, time series value, that is company's own historical track record of valuation. The third piece is the earnings growth piece, which I call as momentum. It is not just pure price momentum. Yes. Yeah. So that's the piece I wanted to put it there. And the question that you asked, can you just repeat the question that you just had? Yeah, phases of underperformance. See, Shekhar, I think anybody who says that I outperform all the time, no. That Ponzi is the only guy I'm reminded of. So we all go through bouts of underperformance for sure. But in that, what do we do? There are 2 things which we sort of think about when this happens. One is the current portfolio. The current portfolio, I go back to portfolio, right? I mean, so I go back to my portfolio, I evaluate each of the companies. Have we actually, this company that I have in the portfolio, like for instance, somebody may have Asian Paints, for instance. Does this company qualify for quality? Answer is yes. Does this qualify for value? Not the traditional definition of value, but maybe compared to its own historical track record as we speak, probably qualifies for value. Does it have earnings momentum? Probably the answer is no. And I would like to think about why the earnings growth, earnings momentum has gone away. It is because Birla Opus and all of these heightened competitive intensity, right? Clear case that I have made a mistake of putting this in the portfolio. It should be out. My worldview has changed now. What I thought was Asian Paints is no more Asian Paints. So remove that from the portfolio. So that is one. So when in underperformance, right, we go back to self-doubt. Go and check whatever you have done. Does it pass the filters, tests that you have started your portfolio with? That's the first step. Second step, you know what happened, Shekhar? This October 21, right, was the last peak of sorts. Right? In general, we have not been used to investing in capex proxies. These capex companies were coming back after a long time, perhaps a decade.
Yeah.
Right? And we did not have any representation of capex in our portfolios. So then the question is, so the sector which is there, like, you can easily sort of, from a quality standpoint, you can easily introduce pharma, because obviously everything sorts of maps out there, IT, consumer, certain auto components, and some banking, right? But this is a sector which probably is, what should I say, is slightly volatile, right? And it was effectively gaining because government started spending, which means there is a government dependency there. So it's a new sector, right? And hence we need to evaluate sectors which are in your portfolio, but sectors which are not there in your portfolio, which are hitting 52-week highs, do they qualify for your filters? Are you doing the mistake of omission? First is mistakes of commission, which we discussed. You go through the portfolio, check all the stuff. read everything about it, like go through the earnings transcripts, see what the management is saying, see what competition is saying. That is one. There you have, mistakes of commission, you need to exit, simple. Second thing is where you have this new sectors emerging. First of all, do we have the knowledge to understand those sectors? Actually, even before that, do they qualify for our filters? Then do we have the knowledge to do some of these sectors? And then you go do deep diligence, and maybe you will find one or two, and the representation is filled. So my periods of underperformance is bustling with activity, self-introspection, finding out new sectors. Okay, so I mean, that's but in general, what gives me confidence is whenever we've passed through these periods of underperformance, it has happened time and again. I think 6 out of 9 years till 2019 is where we outperform the index. But in aggregate, we outperform the index, 4 to 5 percentage points, doing the same thing over and over again.
Wow. This is net of taxes, post-taxes and net of...
No. This is pre-taxes. Okay. So maybe shave off another percentage, call it 3%, 3 to 4% is, where we would have outperformed over the long run.
Wow, it's still significant compared to the benchmark indices. And how frequently do you do this exercises of rebalancing your portfolio, like you mentioned, the act of commission and omission?
Yeah, so I would say every earnings season is a period for evaluation, primarily because you may have new winners coming out, right? With stellar earnings growth compared to our expected earnings growth of our portfolio. That is one situation. The second situation is market goes crazy, and the expected IRR at the portfolio level, let's say, goes sub 10%. Not at a stock level, but at a portfolio level goes sub 10%. Those are times where you need to think about, whether to somewhat take a cash call or look for companies which have unnaturally run up, right? Basically where valuations are not conducive and stuff like this. So these are the situations where we would sort of keep evaluating. So it's a continuous process, Shikhar. To be honest, it's not like I have fixed dates and timeframes. We do it on a continuous basis.
Right, got it. Makes sense. And sir, let's say the landscape of PMS, there's always a question that whether one should take the mutual fund approach or PMS or DIY investing. So as an industry representative of PMS, what would be your point of view if someone were to put money? Which options do you suggest? And is there a merit to have all three in one's portfolio?
Right. So, I mean, each of these, first we will talk about third parties, then we will talk about sort of PMS, because I mean, I run a PMS, so therefore interested party. So mutual funds, there are great investors, right? In general, there are great investors, like the likes of Mr. Naren, so on and so forth, or Mr. Prashant Jain, who is now running an AIF and all of that. So the thing is, clearly there is a tax advantage for them. That is a fairly well-known situation. But if I look at the composition of mutual funds, the large and mid, in general, the alpha is sort of coming down. And I can understand why, because the sizes have become so huge. And hence the flexibility of moving in and out of stocks has somewhat reduced, right? That is one. Second is, in general, cash deployment. You know that 27,000 crore, 28,000 crore SIP book and all of that coming per month. But in general, you see that the largest cash balance of any mutual fund is probably closer to 20%. So they have to, by sort of definition, they have to deploy all that money into the markets very quickly.
Correct.
This somewhat, yes. So this again takes away some bit of an advantage, right? So there are great guys, and the tax angle is very nice. But all of these, you have flexibility in a PMS structure because of our size and scale, that if you have made a mistake, you can quickly exit without creating a massive market impact and all of that. So as long as these inefficiencies exit, I think there is place for both. Like there are a lot of mid and small cap mutual funds which are doing extremely well, right? Similarly, there are a lot of PMSs which are doing extremely well. So I think there is place for both. And sorry, what was the third instrument you spoke about?
Direct investments, direct stock investment.
DIY investments, I mean, somebody like you, there's a lot of good people out there who are training people in what needs to be done, right? So, and there's a lot of learning which happens on that SOIC, right? Is another situation where they're teaching people very well. So I think people can do, but I think given that you will be busy in your day job, right? I mean, you will be doing something else, and then you will be doing this. So it's not your full-time role. So, I mean, I would only qualify it saying that it's good to learn these things, but probably you're better off doing it with a professional money manager.
Makes sense. Makes sense, sir. Sir, since you've been also part of the technology industry and you also built an app by yourself, I wanted to ask this question, which is specific to the PMS industry. Do you see any specific areas within the PMS industry which are ripe for disruption through technology or research?
Sure, Shekhar. So the way I think about it is, right, operations in for any PMS entity is a very cumbersome job, to be honest with you.
Okay.
So anything that facilitates this process of order management, like I can see why there can be a centralized order management system for a PMS entity that it has to do two things, right? It needs to be embedded with all the brokers, it has to be embedded with all the custodians, and the interface needs to be beautiful, right? It has like right now we are doing this on a Google Sheet.
Okay.
Google Sheets, because price and allocation and, like incrementally how much should we buy, and then whether the weights for a new guy, are they aligned with sort of the quasi model portfolio or not? Are we missing out any trades? All of this stuff. That is the first point I would say. Like something like an OMS or a good tech wrapper around OMSs is beautiful to have. So I don't see that. First point. Second point, the performance management module as we speak, right? So if you have somebody like Wealth Spectrum, which is the DPMS part of the PMSs, it is there. Like you tie up with a custodian, the custodian in turn is tied up with Wealth Spectrum. They give you great performance reports, which I think look and feel can somewhat be improved and all of that. I mean, it should be in a position, we should be in a position to customize it, but the benefits are incremental. But so within PMSs, you have these large family offices who come only on the advisory mode, even for a PMS. Now, for somebody like that, right, we don't have a good scalable performance reporting platform. That's one more area where, something can be done, right? So this is the second aspect. If this is about like, if we are talking about operations on the research side, right? On the research side, I still need to see, like if you use TradingView, I do not have a place. Okay, Screener somewhat helps you, Screener from a fundamental standpoint. But where you see this blending of fundamentals, which is like ratios and P's and all of that, with your charting software. In a beautiful way. I mean, there are these discrete situations, right? I mean, TradingView you use independently, then, charting maybe you use independently, then, Screener.in you're using for fundamentals and all of that. But in combination, I don't see like a great tool because that will make your life simpler. Yeah, like like I have these filters, right? I need these stocks, but I also need earnings acceleration. I also need that fellow investors are liking this stock, which is hitting 52-week highs. So you combine these and you look at the screener, and then you start your deep dives. Something like that would be really helpful.
Got it. Yeah, I think there is a lot of innovation still to be pending. I mean, the first wave of innovation wasn't just the laying the digital infrastructure of the broking, getting the that's where you saw the Zerodhas and Grows scaling up. I think the next set of innovation we'll see the wealth tech booming in.
That's right. And you are like Quantopian, right? I mean, I would like to see Momentum Labs for all the momentum practitioners in India. Use your stuff to backtest easily. Like no code basis backtest, right? I mean, most of these probably quant investors probably do not code as much as you do. So you should have a no code platform where you get all of this and you backtest your strategies, right? Like whatever Wesley Gray has done in that entire book.
Right.
Yeah. So all of that should be done.
So you're mentioning about the importance of backtesting any strategy before we deploy, and that was a reference from Quantitative Momentum book written by Wes Gray. And apart from that, what is a recent book that has caught your attention, and what are you reading right now?
So I mean, on quantitative investing, a lot of these books are great. Yeah, like right now I'm reading a book called Barefoot Coach by Paddy Upton, who is Gukesh's coach. I mean, he basically, that Greg Chappell episode, right, of yesterday's Greg Chappell, Saurav Ganguly, and then like Gary Kirsten got Paddy Upton to coach the Indian cricket team. And they went on to win under Dhoni, and they went on to win World Cup and all of that, right? So he's the same coach who's now coaching Gukesh. Mukesh is now contending for world championship in chess, right? So, that is that. But if you were to ask me what are the quantitative books like which are great to read, I think Wes Gray's book, as you suggested. Then What Works on Wall Street by James O'Shaughnessy, right?
Right. Yeah. James.
So yeah, I like that better because I think in general people have done single factor analysis.
Right.
Take one factor and backtest it. Shaughnessy's appendix has multiple factors at work. Like basically, not only single factors, but like, you have like a 52-week high with value. How does it do? ROE with 52-week high. How does it do? And combination of three factors. So that's a beauty. I mean, in that you will see that this ROE, if you combine quality plus plus momentum plus time series value, it does not come high very much on returns, but Sharpe ratio is decent. So which is basically sleep well at night sort of thing. So it does not chase returns, but it is safety sort of thing. So that's a very interesting book. And then of course this one, yeah, that Birkin's book, right? Factor investing.
Yeah. I got the idea.
Yeah.
I'll share that book link. Viewers, I'll share the book link. I'm not recollecting the name, but yeah.
Yeah. So then that Pim Van Wallet low wall. I mean, he's this thing is his specialty was he basically did this, right? I mean, one is 52-week highs with low wall. Yeah, exactly. Yeah. So that's one more interesting book. What else here? I think these, and in general, like, I mean, so the original papers are also very nice now, but the Jagdish Titman and all of this.
Right.
So yeah, I mean, those are the things. Yeah, please go ahead.
There is wealth of knowledge out there. Just to we need to have time to imbibe them.
Oh, absolutely, yeah. And I think we need to be flexible. Like one of the things that I see is that the fundamental crowd is purely fundamental. They don't want to see any other thing. The quant crowd is purely quant. They don't want to see any other thing. But there's a beauty if you blend these both.
Right.
So yeah, I mean, that's how I would put it.
Yeah. Those prejudices are still there. And good. Yes, that's a valid observation, sir. And I would want to wrap the discussion by, let's say, if people want to reach out to you for any of the questions or queries or investment opportunities that you have, how do they reach out to you?
Yeah, so I think best is to reach out on Gmail here. I'm not so active on Twitter and all that, but maybe they can just DM on Twitter also. But yeah, I mean, Sarkay, Sarkay is the Twitter handle. Otherwise, Gmail is chaitanya.j at gmail.com. Yeah, so we're happy to speak.
Great. So I'll be putting those in the YouTube description. You can always reach out to Chaitanya if you have any questions on quality, momentum, or anything related to investing. It was a pleasure having you, Chaitanya Garu. Have a nice day, and thanks a lot.
Yeah, awesome speaking, man, Shekhar. Thanks for your time, and thanks for this opportunity.